In August 2022, one speech lasted just 8 minutes. No new law was passed, no war was declared, no major company collapsed, and yet within minutes, the stock market lost nearly $2 trillion in value. What happened? Jerome Powell stepped up to a podium and said something simple. Interest rates would stay high. That was it. 8 minutes, a few sentences, a shift in tone, and global markets reacted instantly. Here's the point. The most powerful force in the American economy isn't Congress. It isn't the president. It isn't even Wall Street. It's the Federal Reserve. And most people have no idea how much control it actually has over their lives. Your mortgage rate, your job security, your credit card interest, your rent, your retirement account. All of it is connected to decisions made in a building in Washington, D.C. So today, we're going to break down exactly how the Federal Reserve controls the U.S. economy. Look, the Federal Reserve wasn't created casually. In the early 1900s, the U.S. experienced repeated banking panics. Banks failed, depositors lost savings, markets crashed. The worst of them, the Panic of 1907, nearly collapsed the financial system. So in 1913, Congress passed the Federal Reserve Act. The goal? Create a central bank that could stabilize the system. But here's what makes the Fed unusual. It's independent. It exists within government, but operates outside day-to-day political control. Presidents can appoint the chair, Congress can oversee it, but neither can directly control its decisions. That independence was intentional, because whoever controls money controls the economy, and that kind of power can't swing with election cycles. At the center of it is the Board of Governors and 12 regional banks, but when people talk about the Fed, they usually mean one thing, the chair. And when the chair speaks, markets listen, not because of personality, but because of policy. Here's the Fed's official mission. It has what's called a dual mandate. Maximum employment, stable prices. That's it. Not high stock prices, not political popularity, not GDP growth at any cost. Jobs and price stability. Now, here's the tension. These two goals often conflict. If the Fed lowers rates too much to stimulate hiring, inflation can rise. If it raises rates too aggressively to fight inflation, unemployment can increase. So every decision is a trade-off, and those trade-offs shape the direction of the entire economy. It's like steering a massive ship through fog. Too slow, and inflation builds quietly. Too aggressive, and you hit recession. And history shows both have happened. Here's where things get real. The Federal Reserve controls one critical number. The federal funds rate. That's the interest rate banks charge each other for overnight loans. Now that sounds technical, but here's why it matters. Every major borrowing rate in the country is influenced by it. Mortgage rates, auto loans, credit cards, business financing, student loans. When the Fed raises this rate, borrowing becomes expensive. When borrowing becomes expensive, people spend less, businesses invest less, hiring slows, housing cools, the economy slows. When the Fed lowers rates, borrowing becomes cheaper, spending increases, risk-taking rises, asset prices often climb, the economy accelerates. It's like a master dial controlling the cost of money. And money is the fuel of the modern economy. Change its price, and behavior changes instantly. Let's talk about what happens when inflation spirals. In the late 1970s, inflation was out of control. Gas prices surged, food costs jumped, confidence collapsed. The Fed, under Paul Volcker, made a radical decision: raise rates dramatically. At one point, the federal funds rate exceeded 19%. 19%. Imagine buying a house at that rate today. The economy went into recession. Unemployment spiked. Businesses struggled. But inflation eventually broke. That episode proved something powerful. The Fed is willing to cause short-term pain to restore long-term stability. That credibility matters, because once people believe inflation will stay high, it becomes self-fulfilling. Expectations shape reality, and the Fed knows that. Fast forward to 2008. The financial system was collapsing. Banks failed. Credit markets froze. The economy was spiraling into what became known as the Great Recession. The Fed slashed rates to near zero. But here's the problem. You can't go below zero easily. So it introduced something new: quantitative easing. Instead of just lowering short-term rates, the Fed began buying massive amounts of long-term government bonds and mortgage-backed securities, trillions of dollars worth. This injected liquidity directly into the financial system. Markets stabilized. Credit started flowing again. The collapse slowed. But QE changed the scale of the Fed's influence permanently. Its balance sheet exploded, and its role in markets became larger than ever before. Then came 2020. The global economy shut down almost overnight. Markets crashed at record speed. The Fed responded faster than ever. Rates were cut to zero. QE resumed at historic scale. The Fed even supported corporate bond markets directly. It wasn't subtle. It was overwhelming force. The message was clear: liquidity would not run out. And once again, markets stabilized. Stocks recovered rapidly. Credit flowed. But here's the twist. Massive liquidity, combined with fiscal stimulus and supply chain breakdowns, created new pressure: inflation. By 2022, inflation reached levels not seen in 40 years. Groceries cost more, rent surged, energy prices spiked. The Fed had to pivot, fast. It began raising rates aggressively, the fastest hiking cycle in decades. Mortgage rates doubled in a year. Housing demand cooled sharply. Tech companies cut jobs. Risk assets fell. This is how the Fed slows the economy. It makes money expensive. And when money becomes expensive, decisions change. Businesses delay expansion. Consumers postpone big purchases. Investors reassess risk. It's not force, it's friction. Now here's something most people miss. The Fed doesn't just move markets with action. It moves them with language. This is called forward guidance. If the chair hints that rates may rise in 6 months, markets adjust today. Stocks reprice, bond yields shift, mortgage rates move, all before a single rate change happens. Because the economy runs on expectations. If businesses expect a slowdown, they reduce hiring now. If consumers expect inflation, they change spending behavior now. The Fed shapes expectations, and expectations shape reality. In many ways, its most powerful tool isn't interest rates, it's credibility. The U.S. dollar is the world's reserve currency. That means global trade, global debt, and global finance are tied to U.S. monetary policy. When the Fed raises rates, capital flows into the U.S. Emerging market currencies weaken. Dollar-denominated debt becomes harder to repay. So the Fed doesn't just influence America, it influences global liquidity. A decision in Washington can tighten financial conditions in Asia, Europe, and Latin America overnight. That's scale. That's power. But here's the truth. The Fed is powerful. It is not all-powerful. It cannot fix supply shortages. It cannot produce oil. It cannot legislate tax policy. It influences demand. It influences credit. It influences liquidity. But structural economic problems require fiscal solutions. And sometimes the Fed acts too late. Sometimes it overshoots. Sometimes it tightens into a slowdown. Recessions don't always happen because the Fed wants them, but sometimes they happen because policy is mistimed. And that's the risk of steering a $25 trillion economy with imperfect data. Who really controls the economy? So here's the real question. Does the Federal Reserve control the U.S. economy? Yes, but not like a dictator, more like a thermostat. If inflation overheats, it cools the system. If recession threatens, it adds warmth. But thermostats have lag. They react to past temperatures, and sometimes they overcorrect. That's why small percentage changes in rates can mean higher mortgage payments, more layoffs, lower stock valuations, stronger dollar pressure abroad. It's not dramatic on the surface, just 0.25%, just a press conference, just a policy statement. But behind those small adjustments is the direction of the entire economy. And whether most people realize it or not, the Federal Reserve quietly shapes their financial future. Every rate decision, every signal, every shift in tone, it's all connected. And the next time you hear that the Fed is meeting, understand something simple. They're not just discussing numbers, they're adjusting the cost of money. And when you adjust the cost of money, you adjust everything.